Good morning, everyone, and welcome to today's webinar, which is Construction Outlook, What's Next for the Industry. So my name is Richard McLean. I'm the Chief Commercial Officer at BCIS. And today, most of the talking will be done here by my colleague, David Crosthwaite, our Chief Economist. So good morning, David.
Good morning, all. Lovely to be here on a rather rainy autumn morning.
Probably reflective of what we're going to cover today, I think, David.
Absolutely not. No, very positive outlook, I think.
Brilliant. Okay, so just a bit of housekeeping before we start. Sorry for those who join us regularly, but just to cover the basics. So this webinar today is being recorded. It will be shared with everyone who's registered. It will also be accessible on our website, bcis.co.uk. And if you want to stay up to date with the latest news and insights from BCIS, if you could give us a follow on LinkedIn, it would be greatly appreciated. So we have a number of questions already prepared for the webinar, so we'll answer those towards the end. However, there's also a Q&A section for you to answer any questions, so please feel free to. We also welcome any questions through the presentation. So if you can see the Q&A mark, you pop those in. We'll try and pick them up either throughout the webinar or we'll focus on the end. If we don't get time to answer all of the questions, we'll do our best to answer them after the webinar, and we will share them with everyone as well, along with the recording. Okay, so you'll also notice, as usual, we've got some poll questions that will pop up during the webinar itself. They can also be accessed at any time via the little graph icon you can see on the toolbar. The purpose of these questions is really just for us to understand what you're seeing in your own role and part of the industry, so they can really help us think about the future content that might be useful. So we would appreciate if you could contribute, that'd be great, and I'll be politely sending some nudges throughout the webinar. So to allow all the questions to be answered right up to the end of the webinar, we won't publish the answers during the session, but we will share the full results with the recording. If you've got any questions isn't relevant to you, please feel free to just ignore them and click away or select not applicable. Now, following the webinar, you'll receive a short survey asking you for some feedback on the webinar. It would be really great if you could just spare a few minutes for us. It means a lot for us and it really helps us drive the content and hopefully make these better. So please take the time. And there's also an option to ask any questions. If you don't have the chance to ask them during the session today, feel free to pop them in and we'll include them as well. Okay, right, that should be enough for me. So without further ado, we'll pass on to David.
Thank you very much, Richard. A quick apology in advance. I'm a little bit sniffly this morning, so I don't know whether it's hay fever or a cold, but I know how annoying that can be, so please bear with me. In terms of agenda, what we're going to cover today, hopefully most of you on the call will be aware of the format, but just in case you aren't, we're essentially looking at the prospects for the construction sector over the next 12 months. And to do that, we'll have a quick look at our forecast of future demand levels. Then we'll look at a bit of inflation, so look at cost and price movement in construction. We'll then summarise what we've looked at and take any questions, as Richard said. At the end, we've already had 4 submitted pre-webinar, so we'll answer those. But anything else that springs to mind as we're going through, please feel free to pop your questions down and we'll get to them if we can. So if we move on to the next slide, quickly setting the scene. Obviously during the summer months and the general election, there was a bit of a hiatus in our sector and probably throughout the wider economy, to be honest. But we seem to have got a little bit of stability, certainly slightly more stability than we had leading up to the election. And some of the new government's plans sound promising for our sector. I mean, there are some that don't sound quite as promising. But the slogan, "Get Britain Building Again," is intriguing, I think. Certainly for where I'm sitting, although a caveat to that is that there doesn't appear to be too much substance in terms of how they might go about getting Britain building again. And I think, as is always the case in politics, I think the Labour government are finding out it's easier actually to be in opposition than it is to be in government. but they really aren't helping themselves with the constant rhetoric that we seem to be getting at the moment about the dire state of what they've inherited. And this is really crucial for our sector, which is reliant to a massive extent on investment. And talking down the UK and the UK economy is not likely to encourage investors to our country. So if they're serious about growing the economy, they really need to focus on investment, and we're hoping that the budget upcoming will outline some of that investment. If we move on to the next slide. Hopefully some of you were on the webinar we did post-election, where we sort of reviewed what some of the outcomes might be. And we examined the impact of different governments on construction output, just to see if there are any trends, obvious trends. And we went back to May '97, and we found out that new work construction output actually grew under the last Labour government, and that's all of them, not just one. And it was flat during both the coalition and the last Conservative governments. So it would seem to suggest that Labour do encourage new work output growth. But when we looked at infrastructure in particular, obviously reliant on public finance to a certain extent, we found the reverse of that. So we found that actually the Conservatives had significant growth evident when they were last in power, and under previous Labour governments, actually infrastructure output declined. So it'll be interesting to see if those trends hold true going forward. If we now move on to the main element of our presentation today, we'll look at output and orders, and using a combination of BCIS and ONS data, we'll try and get a handle on the current outlook for our sector. So first off, if we look at construction output, both in totality, and that's the grey line at the top, and then broken down by the sort of broad sectors, so that's new work and repair and maintenance output. And you can clearly see that the total construction output is currently flatlining, according to the latest data from the ONS. And we at BCIS expected to plateau for the rest of this year. You can also clearly see that there are declines evident in new work output over the last year, and certainly while repair and maintenance output has been the driver of any growth in total output over the last few years, it looks like that's starting to turn down now. So our forecast for output is that output growth will likely remain subdued for the remainder of this year, and we expect a slow recovery through 2025 before growth really starts accelerating from 2026 onwards. And contrary to the last few years, we're expecting that most of the growth will come from new work output. And we're predicting that repair and maintenance output is likely to stagnate over the forecast period. So if we go on to the next slide and we look a little bit more detail at new work and how that's made up by the different subsectors, essentially there have been significant declines over the last couple of years, particularly in private housing, which has seen a 24% fall in output since it peaked at the end of 2022. And contrary to our previous forecast, we're actually we're a bit more bullish about housing output, and we're forecasting rapid growth in the sector from next year onwards. And this is a result of pent-up demand starting to feed through to house price growth, and we're expecting that will encourage developers to start building again. Also combined with that is the recent modest, and it was pretty modest, base rate cut is likely to improve affordability, even though the base rate only came down by 25 basis points. Mortgage providers have started feeding some fairly substantial cuts through to their customers. So we're predicting that housing output will start picking up quite significantly. Having said that, I think we need to point out that home buyers need to adapt to what looks like the new normal. We're expecting interest rates to settle at around the long-term trend of between 4 and 5%. So that there's not going to be sort of a rush to the bottom again with interest rates around 0%. So encouraging for private housing output. Infrastructure output, which is the next largest subsector, has recovered recently, but it is still below the peak reached a year ago. And for much of this sector, output is going to depend on what comes out of the budget. We're expecting some marginal growth later in the forecast period out to 2029. And we do expect output to be maintained at a relatively high level in infrastructure, but most of this is going to be clarified in the upcoming budget, hopefully. The next largest subsector you can see, the grey line, is commercial output, and that has never really recovered from the falls it saw post-financial crisis. Back then, it was the largest subsector by volume, and if you look at output over the last, well, since 2007, it's actually, commercial output's lost 40% of its value, and we're predicting output to be sort of remain stubbornly flat in commercial, with only relatively marginal growth expected over the next 5 years. And the reason for this is that demand for office space has not really recovered post-pandemic, and we don't expect it to reach the heights seen previously, given that the way the working world has changed. There's also starting to be some issues in terms of lending in the commercial sector. Could be stoking a subprime issue. So commercial property assets are starting to lose their value, so lending against them is starting to become problematic. So we're not expecting commercial output to recover at all, really. But overall, for new work, as the previous slide suggested, that we're quite bullish. So we're expecting total new work output over the 5 years that we're forecasting to grow by about 24%. So significant growth. If we move on to the next slide, where we look at the repair and maintenance output broken down by subsector, as you can see, the period of significant growth is quite clear, but it does appear to have turned a corner and started to decline. And this is largely, I think, a result of cost of living pressures and issues with public finances. And we're expecting those to persist for the next couple of years. Public housing repair and maintenance output remains subdued, with virtually no growth over the forecast period. But the much larger private housing and non-housing repair and maintenance sectors, we're expecting to decline fairly significantly from the peaks they reached earlier this year. Moving on to the next slide, and here is some quite good news, I think. We look at construction new orders, and on an annual basis, new orders were up across the board, with the most significant increases being in housing, infrastructure, and to go against what I've just said, commercial sectors. And in total, construction new orders increased by 17% in the second quarter of this year, compared with the first quarter, with just over £12.5 billion worth of orders placed, and that was the highest level of new orders since the end of 2022. And encouragingly, the private housing sector saw a 12% increase in new orders, with over £2.8 billion worth of orders, and that was the highest level since the fourth quarter of 22. This is good news. I mean, a significant uptick in new orders in mid-year is really good news for our sector. and should translate into an increase in output over the next few quarters. The most encouraging data, I think, is the increase in housing orders, which obviously had suffered significant declines in output since the pandemic. And this could really herald a change of fortunes for the housing sector, the largest of all the construction subsectors, and a key driver of growth for our sector overall. If we move on to the next slide. So a quick summary of our growth predictions by sector, and this chart has changed.
David,
yes.
David, sorry, I was just going to say we've just got a question pop in while we're on there. If
Okay.
It would be quite apt. So I had a question in from Gina, and is the Labour government not looking to increase the quantity of social housing to be constructed during their tenancy in Parliament? Are the BCIS not confident this will be the case? And as you're forecasting private housing to overshadow all of the sectors?
Yes.
Great. Right, next question.
Delivering housing is a stated aim of the new government. My issue with that aim, and I think it's a lofty ambition, is I'm not really sure how they're going to deliver the volume of new homes that they're calling for. It works out roughly at about 1,000 a day, and because of the way housing is delivered by private property developers, who essentially control the supply of housing to make sure they can realise adequate returns on investment and make a good margin. It's not in their interest to increase supply dramatically. So I think supply levels from the private sector will probably tend to average what they've been doing over the last few decades, which is around sort of 200,000 new homes a year. The only way that the new government could really increase that is to go back to public housing being delivered by direct labour organisations, so actually taking responsibility for building social housing themselves. I'm not saying that that's not possible, because it certainly was possible in the 1970s. But my issue is that given the state of the public finances, I think it would be very difficult for them to actually break into public housing delivery that way. I remain to be convinced that they can actually hit their new home delivery targets. Hopefully that answered the question.
We'll find out. I'll let you know if we get a comment.
I'm sure she might come back. Yeah.
Actually, we've got one of them while we're on here, actually, so it probably makes sense to cover it as well. So we've had a question from Robert Howard. Robert's saying, my employer is suffering delays due to getting new projects through the building safety process due to lack of capacity and approval. So what he's asking is, without a significant increase in the capacity to review and approve new projects, I can see this being a break in growth. What are your views on this?
Yeah, absolutely. I think that's a really important issue, and it did pop up in one of the questions that we've already answered at the end of the presentation. I do think that the public sector's capacity to not only in planning but also in overseeing construction project delivery, particularly with regards to infrastructure, it is a real blocker. And until that improves, these sorts of issues are going to continue. So public, I mean, I can remember building control being delivered by public sector organisations, which is no longer the case, and planning used to be much quicker. So absolutely, I do think capacity, not just of construction trades, but also in construction professionals, on the public sector side is going to be an issue going forward.
Great, thank you, and yeah, thanks for the questions. Please keep them coming in. I'll let you move on to your next slide now, David.
Okay, yeah, which is essentially an overview of our growth predictions by sector. This chart is slightly more encouraging than the last quarter's chart, which essentially I think was all amber with one red. This is slightly more positive now. We've got a couple of greens. for new housing and new infrastructure, which you know, we've just been talking about over the last few slides. Those are the areas we think that growth is going to come from. So in the short term, uplifting new housing and new infrastructure, whereas the rest of the subsector is going to be fairly subdued, I think, in the short run. So move on to the next bit. We're looking now. So that's our sort of summary of output and orders and future demand levels. Now, if we move on to what the inflationary impact might look like over the next few years, using a combination of BCIS cost and price data. So everything is looking much more benign than it has been over the recent past. Now this slide shows annual growth in tender prices and building costs. So annual growth in tender prices, we're seeing a continuing to ease, falling from 10% in midpoint of 2022 to around 2% at the third quarter of this year. So much more benign than they have been. However, we are expecting annual growth in tender prices to go up slightly, so to be about 2.6% in the first quarter of next year. And this is largely as a result of increased market activity. And we're predicting that prices will actually rise faster than costs from the midpoint of next year onwards. So we're forecasting tender prices to rise by about 20% over the next 5 years to the third quarter of 2029. So if we look at building costs, as measured by the BCIS General Building Cost Index, they decreased slightly, very slightly by 0.2% in the third quarter, resulting in annual growth of about 3% year on year. And similar to the previous webinar, inflation in building costs continues to be driven by labour costs rather than materials. But we are seeing that labour cost impacts are starting to soften now. And overall costs in the General Building Cost Index, we're predicting to rise by 15% over the next 5 years. Labour costs will likely remain the key driver until 2026. So if we move on to the next slide, which goes into a bit more detail as what might be driving the building cost and tender price indices. And we can see the dramatic decline in the materials cost index. However, we are seeing muted growth in materials cost inflation, and we're expecting that to continue into the latter half of this year. The BCIS Materials Cost Index forecast to grow marginally by 0.3% in the 3 months to the third quarter 2024, and that's the first positive annual growth that we've seen in materials costs since the midpoint of 2022. We're expecting materials costs to maintain their upward trajectory through to 2026, before they sort of stabilise at around 3% through the rest of the forecast period. Overall, we're predicting that materials costs will grow by about 15% over the next 5 years, but much more subdued compared to the recent past. And if we look at labour now, if we look at the BCIS Labour Cost Index, we're forecasting growth in that to slow. It's around 6% this quarter. And although wage growth is continuing to outstrip inflation, there are signs that pay rises are starting to moderate now. And we're forecasting that labour costs will grow about 16% in general over the forecast period to the third quarter of 2029. It is worth noting, though, the risks to this forecast remain on the upside, as skill shortages are still prevalent in the market and continue to impact project delivery. and that's in particular trades, mechanical and electrical specifically. But I think if there's an uptick in demand, then we'll really have to look at labour costs if capacity is constrained, see how that has an impact. Also, typically we normally look at growth in construction earnings. If we move on to the next slide, just to sort of as a sanity check on our labour costs, and we're looking at the Hayes BCIS site wages, which is the purple line, and then average weekly earnings for construction, which is the orange line. And the data sort of indicates that construction wages are stabilising at around 4%. So the average weekly earnings data set increased by 4% in the year to July. It is worth noting that annual growth in earnings has been lower in construction than the whole economy average each month since April 2023. But they recently show that they're sort of converging, and I think this is largely as a result of earnings growth in the wider economy declining. And what else is interesting about the ANO data for average weekly earnings? It shows that the construction sector has experienced the most extreme fluctuations in earnings movement, from a 10% annual decrease in May 2020 at the sort of height of the pandemic, to a 14% increase in May 2021. So massive swings in earnings there in our sector. And if we compare that to annual growth in the Hayes BCIS site wage cost index, that shows site rates rose slightly more than the AWE, about 5% in the second quarter of this year, and that was down slightly from the 7% recorded in the first quarter. Any increase in the Hayes BCIS wage cost index is mainly driven by a 50% uplift in rates for skilled mechanical and electrical trades, where there are ongoing capacity issues in that sector. Okay, if we move on to the next one, which is our sort of summary of market conditions. So we could get a sort of hint of what market conditions look like going forward. And the BCIS market condition index is the relationship between costs and prices. And at the third quarter of this year, the BCIS MCI is forecast to decline by 1% compared to the previous quarter, and that results in a fall of about 0.6% if you compare it with a year earlier. And just to note that when the market conditions index is rising, prices are rising faster than costs, and when it's falling, costs are rising faster than prices. So despite all the data we've just looked at, we're still seeing costs marginally rise faster than prices. So we haven't quite shaken off the costs impact. But if we look ahead through to 2029, we can see that stabilizing materials prices and the sort of steadying labour site rate increases that we've seen recently, they'll start to impact will start to lessen, and we start to see the market conditions index rising towards the end of this year, and we're then predicting that prices will rise faster than costs over the rest of the forecast period. A caveat to that is that we'd need to see output levels maintained, so it sort of harks back to our previous forecast of output. We're expecting output levels to start increasing from next year onwards before they uptick quite significantly in 2026. So to see what we're predicting in this index, we need to see demand levels match our forecasts. Okay, so that's the fairly positive view of what's going to happen with demand. going forward, and how we expect the inflationary impacts to be moderating. But there is only so much that hard data can tell you. So considering the lag in producing statistics, and there is quite a lag, if you probably noticed on the AWE chart, there's only data available up till midpoint of this year, and obviously we're already beyond that. So one of the issues with statistics is that lag in production. So to overcome that, we obviously now examine some of the comments made by the members of our industry panel. So if you quickly flip on to the next slide, please. And we've got some highlights from the latest meeting, just to get an idea, an understanding of current conditions on the ground, as it were. So next few slides will just provide a sort of summary of that. And these are comments made by the panel. So first off, if we look at supply and demand, so broadly speaking, that the panel members are seeing a rebound, and they're expecting that, well, they're highlighting that some of that's driven by increased customer confidence, although noting that optimism will probably take time to be converted into real work on site. As we saw in the new order slide, the sector's rebound is underpinned by a sustained increase in orders, and that's necessitating expanding purchasing activity and some workforce growth. Restored client confidence has unlocked a pipeline of previously deferred projects. So clients are now coming to market with projects that they've probably been sitting on for a while. Looking at materials prices, they've noticed that they've moderated, although labour costs continue to pose a significant challenge to project budgets. The scarcity of skilled workers not only increases costs, but also undermines project efficiency, leading to delays on site and therefore some reduced productivity. And another comment that sort of focuses on capacity, and we'll pick this up a little bit later actually, is the capacity of the industry has been further eroded by insolvencies. And obviously we've just had a fairly big one announced over the last few days, the administration of ISG, which we'll pick up in one of the questions. And that loss of key industry players can really disrupt supply chains, and that reduces competition, and then potentially those combine to exacerbate any inflationary pressures. So it's something we need to watch going forward. But generally, the panel have a sort of fairly optimistic view, but also countered by what may happen with capacity if demand picks up. Next slide, we look at procurement and trades, and there's continuing reluctance towards single stage tendering, and risk premium pricing, and a preference for negotiated contracts. And panel members noticed that contractors are being more selective on the tender routes that they're willing to work on, preferably two-stage or target cost contracts. Not much appetite for single stage tendering, and volatility is still being priced into fixed contracts, and contractors are including risk premiums when pricing. In terms of trades, and we pick this up in the BCIS Hayes Site Wage Index, continuing pressure in the mechanical and electrical market. That market continues to experience higher levels of price increases than most other trades. The key reasons appear to be labour costs and the higher proportionate impact on tender prices of materials price fluctuations with components, particularly those being imported. And another comment was MEP trades are being priced at a premium due to a lack of supply capacity. So again, that's something we picked up in the BCIS Hayes Index. Moving on to the next slide, we have comments about the logistics. So noting that essentially logistics challenges have reduced. But again, anything mechanical and electrical, and this comment notes for data centers in particular, they're subject to a long lead-in period that needs careful management and planning. And again, that harks back to the issues about importing components. Another significant issue noted was program impacts occasioned by the Building Safety Act regulations on high-risk buildings, and that harks back to a question that was asked during the webinar. And I think a lot of these things are conspiring to slow down the project process. So it is something we need to keep an eye on going forward. And general other comments. There are some concerns around larger schemes and the current impact of uncertainty with the government reviewing projects, which hopefully we'll get some clarity on in the budget. And another noted that there are a significant number of schemes waiting to come to market when the overall economic picture improves. And when those projects do come to market, and this is something that we've been caveating with our demand forecasts, is that the pipeline of projects could actually start producing some pinch points as capacity becomes an issue, and obviously that will probably feed through to inflation. So flick on to the next slide, and we'll summarise what we've just covered fairly quickly in terms of output and orders, costs and prices, and the comments from our industry panel. So we've seen that output is currently flatlining, but the good news is that orders are increasing, and that should feed through to output growth in future. Building costs currently stable, tender prices easing, but they're forecast to increase as demand pressures build. Materials costs increasing slightly, labour costs still increasing, but that rate of increase is slowing. However, we've got ongoing pressure in the mechanical and electrical market as capacity constraints continue to drive price increases. And touching on what I mentioned just now, the administration of ISG, Interior Services Group, is likely to have some serious knock-on effects for our sector. This is the largest business failure since Carillion, and I think the impacts will be fairly significant. So that's the sort of the outlook for construction. And if we quickly conclude and return to our original question, what next for our industry? The data tells us that essentially the worst is probably behind us. The future will likely depend on the outcome of the budget. So we're looking forward to that at the end of October. And also any project reviews being carried out by the government, and there are a few, particularly on the infrastructure side. It's early days for the new government, and there are some serious challenges remaining. But hopefully the upcoming budget will give us some clarity on the proposed way forward. So that's the end of the presentation. We can now move on to make a start on the Q&A. So the questions that have been submitted over the last couple of weeks. So I must caveat this by saying the answers to this are my opinion and not necessarily BCIS's opinion. But
important to clarify, I think, David.
So the first question was, what would you most like to see in the autumn budget? So I answered this from a personal perspective. I mean, essentially, I'd like to see a commitment by the government to the existing project pipeline, or if that's not possible, then a new project pipeline. But that needs to be done fairly quickly. We need to provide the industry with some certainty that upcoming projects are going to go ahead, that there are defined budgets for them. So first off, I'd like to see the project pipeline cemented, as it were. The other thing that I'm not that keen on in the budget is that the new government are expected to, if you believe the press coverage anyway, are expected to tinker with corporation and capital gains taxes in the budget, which is unlikely to stimulate investment in construction generally. Investment in fixed capital it means more construction. So I'd like to see more investment in fixed capital outlined in the budget. And that fixed capital will be roads projects, rail projects, the stuff that's generally in the previous project pipeline, hospital building, prison building. So we need to see the government supporting those investments in fixed capital. But also more generally, I think we need to see more clarity on what the new government are proposing. We've heard some catchy slogans and some promises, but nothing really about how these things will be delivered in practice. So I'd be really keen, and I'm hoping to see this in the budget, that we'll get some detail about how they're proposing to get Britain building again. Hopefully that answered that person's question. Moving on to the next one. What do you think is going to happen to the base rate over the next 12 months? I mean, this is obviously my forecast, nothing to do with BCIS. In November, I expect there'll be a cut of 25 basis points to put the base rate at 4.75%. And that forecast or prediction assumes that nothing untoward happens between now and then. Next year, I expect rates will settle somewhere between 4 and 5%. If I was pressed, I'd say that rates will be at 4.5% by mid-year. And that's probably where they'll remain for the foreseeable future. I don't see them going lower than that. If you examine the long-term average for the base rate, and I took a quick look to answer this question on the Bank of England website, the long-term average for the base rate going back to 1975 is 9%. So rates, even current rates, are still a long way below that. And I know that the era of cheap borrowing was great while it lasted, but I think it's very unlikely that we're going to see rates like that again. So yeah, my prediction is that the base rate will be around 4.5% by mid-year. But I suspect that's where it will remain. Moving on to the next question, which was
David, sorry, just before we pop onto this, could I just give everyone just a polite reminder, please? We've had plenty of people on the polls so far, but if you could spare a moment, that would be great. Lots of reactions. So sorry, just a gentle nudge from me. So back to you, David.
Okay. Next question: what can NISTA do that the IPA and NIC couldn't? So NISTA is the proposed National Infrastructure and Service Transformation Authority, the new Labour government initiative. The IPA and the NIC are the two current bodies, the Infrastructure Projects Authority and the National Infrastructure Commission. In my opinion, having a single accountable body for infrastructure probably makes sense. Certainly makes more sense than having two disparate organisations. But I guess the proof will be seen in practice. In my view, and we touched on this in one of the questions earlier, the public client needs much more internal expertise in delivering construction projects. And this is sort of harking back to the previous decades, a long time ago, back in the 1970s. And that includes design, engineering, management, and costing. So my view is that the public sector needs expertise in all those areas. I mean, if you look at the recent examples of major infrastructure delivery in the UK, they're not what you'd hold up as best practice. You know, I mean, Crossrail had major program and cost overrun issues, resulting in the delivery of the project being 3 years late. But on the flip side, you know, the line is now very successful. HS2 is mired in timing and cost escalation problems that will make the project late, massively over budget, and also incomplete against the original scope. So we need to change how we deliver major infrastructure, in my opinion. And NISTA, I think, I mean, obviously a lot of this is still fairly unclear, but in my view, NISTA needs to be a fully involved client organisation that's capable of managing and delivering major infrastructure projects, and that's to, you know, not only to get those delivered properly, but also to ensure value for money for the taxpayer, which is you and I. And that's not something that the IPA or the NIC were set up to provide. So I do think we need something new, and it will be interesting to see if NISTA can deliver. And finally, the last question, and we're fairly up against it in terms of time, but you know, this is a really key topic, I think, given what's happened over the last week. What are the likely impacts of the ISG administration? And you know, my view is that the failure of ISG will have serious knock-on effects for our sector. It's the largest business failure since Carillion, and the ramifications will no doubt be serious. Straight off, ISG directly employed around 2,200 employees, are obviously now out of a job. But the main impacts will be felt throughout the supply chain, as subcontractors and suppliers are going to be left unpaid as the administration proceeds. And as we all know, cash flow is critical for construction businesses. And as soon as there are negative impacts on cash flow, then it doesn't take too much for those businesses to fail. So I suspect that insolvency numbers, and we can look at this in the next webinar actually, insolvency numbers will probably rise as a result of the ISG failure. And you know, in addition to that, there's going to be a raft of projects that ISG were delivering at various stages of completion that will be left unfinished, and which clients will need to novate to a new provider as soon as possible to avoid compounding any losses. So yeah, it's an unfortunate situation, but I think as more and more news comes out about ISG, I think this wasn't something that happened overnight. This is something that's been building up for over a year. And my view about ISG diversifying into main contracting is that it was a very strange choice, a very strange decision to move from a niche specialist market delivering interiors, fit out, to becoming a main contractor. But that's obviously something that the board of directors thought was a good idea. In my opinion, I'm not sure it was. And that sort of wraps us up, I think, for today, unless there have been any other questions that have come in that we haven't got to during the webinar.
Yeah, there have actually been quite a few, David. So
okay.
you're not off the hook yet, I'm afraid. Great. Yeah, just thank you for sending the questions. Really have had some great ones. So let me start. Some of them will be specific on previous slides. So I'll try and pick ones a little bit more open-ended. So yeah, great question here from Will. Will the drive to improve housing energy efficiency, reduce carbon, move away from fossil fuels, improving EPC ratings, improve demand for R&M, in your opinion?
It might do in the long run, but in the short run, it's probably going to reduce demand. I suspect as we sort of work out what has to be done in terms of retrofitting. I mean, retrofitting has been an issue for as long as I can remember. I'm talking about it for decades, but never actually getting around to doing it. Theoretically, it should lead to an uptick in demand in the medium to long run, but I think in the short run it might have the opposite effect.
Right. Okay, thank you. This is a really good one. I was thinking this myself. So, does your analysis take account of the excessive cost of the government's march towards net zero and the astronomical proposed vehicle mileage road tax instead of the current annual road fund tax? Do you think will travelling costs increase significantly, driving up the cost of labour and materials?
Transport costs probably will, yeah. But I mean, I think we need, it's like all these things at the moment. Most of them are just speculation in terms of what's going to happen. There's lots of things flying around in the press about a bit like the capital gains corporation tax uplift. I mean, we don't, and to be honest, we don't know. I'm hoping that we will know after the budget, but there's absolutely no guarantee. There's something called a spending review, which is going to happen early next year. So my hope is that some of this will be crystallised in the budget, but my fear is that it won't actually be crystallised until the spending review next spring. So I can't provide a definitive answer to that one, I'm afraid. But we can take it away, and someone else might be able to.
Yeah, let's have a look. That was from Bruce Smith, but thanks for your question, Bruce. I was going to summarise it, but you worded it perfectly. So, okay. So, next question from Joanna Marston. What are your thoughts on developing on greenbelt land?
This is a personal.
Can we put the caveat in, David?
Yeah, this is a personal view. I'm against it, frankly. I think we need to exhaust all other possibilities first, and there are, depending on your definition of what the grey belt is, there are places that can be developed, and that, particularly in inner cities, I think, given what's happened to the commercial sector, this is another issue in terms of providing office space. Someone needs to do a decent analysis of how much demand for office space has declined, and to focus on whether or not we need to be building more homes in cities to be close to office space, because you can't really make that leap until you know what the demand for office space is. So all these things are interlinked. If there is diminishing demand for office space, then building in homes in cities becomes less important. So that means, where do you build them if you're not building them in cities? So yeah, you need to go to the grey belt and probably the green belt. I mean, their definition of green belt, they describe it as ugly green belt, I think, don't they? The grey belt. But generally speaking, I'm not for it. Building on the green belt.
Thank you. So next question, do you feel the outlook for Wales will be in line with the expectations UK-wide? So bearing in mind Labour government was already in situ prior to the new government at Westminster.
Yeah, looking regionally is always tricky, because the statistics are very flaky once you start breaking them down by national and regional. So I'd be loath to say anything based on statistics in terms of Wales. I think the best way to get an answer to that is to set up an industry panel in the region, because anecdotal information, I think, is much better at that level, and informs the sort of lack of really decent national data. So yeah, it's a bit of a fudge in terms of answering the question.
Yeah, you have quite slopey shouldered that one, wasn't it? Brilliant. Okay, I think we're nearly time to wrap up, but I'll try and squeeze in a couple more if we can. Do you see any increase in demand for large-scale EV charging infrastructure, and will the government support it?
If you'd asked me that question a year ago, I'd have said absolutely. there's going to be massive pent-up demand for EV, not only on a domestic basis, in terms of houses, but also across the country in terms of all over the place, so people can charge when they need to. But the market seems to have changed significantly on the EV front, and I'm not sure. I'm assuming it will pick up, but I mean, if you own an EV car, you've probably seen the value of it reduced massively over the last year. So again, it's one of those tricky questions that I can't really provide a definitive answer on. Like I said, if you'd asked me a year ago, I would have said yes, completely. But now I'm not so sure. Logically, yes, it should. Providing those services should increase demand. But now, I'm not sure because of what's happened to the EV market generally.
Brilliant. Okay, great. Thanks, David. Okay, I think we've probably covered most of them. Obviously, we've got quite a few kind of crossovers, so I didn't want to duplicate them. So I think we're probably about there. Just to confirm, as I said at the beginning of the webinar, we will be we'll give a formal response to all of these and circulate to everyone who's attended and booked on there along with the recording as well. So apologies if I've missed your question or we've not quite covered it, but all questions will be answered as soon as we get the time. And I'd say the royal we, it won't be David.
So. Yeah, well, if we can answer them, yeah.
Yeah. Absolutely. Well, brilliant. I think we're good time to wrap up. Yeah, David, thank you for all the time and effort that's gone in. Thank you all for who have attended, and I hope you've enjoyed it.
Pleasure. Hopefully see you all in 3 months' time.
In a brighter world,
if not sooner.
Great. Thank you all.
Bye.